Will the large cap boom turn to bust? Welcome to Market Insight, I'm David Pollard. Nvidia shares appear to have stabilised this Tuesday, but only after a bruising sell-off in recent days, which once again raised fears over just how few companies are behind this year's rally on Wall Street. The top 10 stocks, mostly tech, make up nearly 80% of gains in the S&P 500. On its own, Nvidia accounts for around 35%. Well, those figures are cited in an article in Forbes a few days ago by our guest, Randy Watts, Senior Portfolio Manager at O'Neill Global Investors. Welcome, Randy. Let's look at the lessons of history first. 1973 and the year 2000, both years where narrow, highly concentrated rallies ushered in the end to bull markets. Are we in a similar environment now?
Well, I would say two things. First is that historically when this has happened, and then you've had a subsequent correction or bear market, what's led out of that correction and bear market has not been the same group of stocks leading in. So if you go back and look to the 70s, when you came out of that, small cap and value stocks led. And obviously, when you came out of the internet bubble in the early 2000s, it was really energy and financials and consumer. So I think the point I'd like to make to your viewers is that these situations do not last forever. And historically, when it ends, something else then takes the lead.
So within that, you talk about, in your words, a lack of thematic leadership outside of AI and weight loss drugs from Eli Lilly and Novo Nordisk. Is that market obsession with those spaces concerning not just for stock markets, but also for the wider economy, do you think?
I think it's not concerning in the sense that they are growth areas, so that's good. I think what's concerning is that there aren't more other themes that are working. So it's not that those two themes are bad. It's like we'd like to see other things work. I do wonder if the Fed is able to successfully pull off the soft landing, if maybe we can see an expansion into more cyclical stocks and actually into small cap. You know, the Russell 2000 is essentially flat this year, while the Nasdaq's up about 16%. So small stocks have lagged a great deal in this rally over the last year or so. So I do think they're due to have some kind of a catch-up at some point. What we don't know is the catch-up going to come from small caps going up or from these mega cap stocks coming down.
Well, as you allude to there, one possible outcome is a major sell-off, the end of the bull market. The other is that the rally broadens out to embrace many more sectors. If so, who does benefit, and should we be looking more closely at value stocks?
I think it depends on what happens with the economy. If the Fed is able to pull off a soft landing, which is obviously in doubt at this point, then I would expect it to be more small cap stocks, which are more economically sensitive, and also some of the value stocks that are also economically sensitive, whether those are materials or energy or industrials, and a broadening that way. However, right now, most of the economic data we've gotten recently over the last several months actually points to a slowing of the economy.
So can indeed the Fed pull off a soft landing? Fed Governor Michelle Bowman said today that inflation is still elevated and a steady policy rate is needed, quote, for some time. And yet markets are pricing in a rate cut in September and possibly two cuts by the year end. Are the markets way off the mark as they have been so consistently over the last year or so?
I don't think they're as off the mark as they were earlier in the year. If you remember earlier in the year, the market thought you're going to have 6 or 7 cuts, which was kind of crazy. Now it's looking for 2 with a 65% chance of a cut in September. We're going to know a lot more about this at the end of the week. At the end of the week, we have PCE, which is the Fed's preferred inflation measure. If we could see a soft print there, which I think actually is likely, given that we just had a soft print in CPI and in PPI, I think the bond market could like that, and it could be setting the Fed up for a cut. Again, the issue of soft landing is unclear. Obviously, unemployment has been rising recently from a low last year of 3.4 in April to 4% in the last print. I am hopeful that the Fed can pull this off, but it's very, very hard to do that. And historically, they haven't had a great track record of doing it.
And where is the consumer in all this? We had conference board data today. Its index came in at 100.4, which is slightly above forecasts. We had the University of Michigan Consumer Sentiment Index on Friday. Is consumer appetite showing signs of cracking?
Unfortunately, here in the U.S., we really have a K-shaped economy. And the people on the top of the K are doing really well, that sort of top third. And the reason they're doing well is that the asset prices of things they own, real estate and stocks, have gone up a lot. That bottom third is under a lot of pressure. They've been getting squeezed. Since the start of COVID, inflation has outstripped wage growth. Right now, credit card debt for the consumer has reached over $1 trillion. That's a record level. And the average interest rate on credit cards is 20%. So for the bottom third or the bottom fourth of the, or I'm sorry, bottom 40% of the economy, people have really had to cut back. They've had to trade down, and they've had to really focus their spending on essentials, things like groceries and housing. And so I think right now it's a tale of two areas in the consumer. We're hopeful that this is going to get better over time, but I think the market is worried about whether that top group is going to crack. And in general, we've had a lot of disappointments in consumer stock earnings over the last month or so, and I am a little nervous about that going into earnings season this July.
Okay, Randy, we'll leave it there. Randy Watt, Senior Portfolio Manager at O'Neill Global Investors. Many thanks for sharing your thoughts with us today. That is Market Insight. We have more videos on Reuters.com.